Hey, what's going on, guys? It's Ricky with Tactical Solutions, and today we are going to be live streaming the Federal Reserve interest rate hike. So today is December 14th, 2022, and in the next 4 minutes, the Federal Reserve will be posting if they're going to be raising interest rates 0.75%, which if you want the market to go up, you hope it's not 0.75% and or 0.5%, which in that case, market will go up. So we'll see. We're excited to catch this reaction. Remember, I do host these live streams anytime that there's any form of economic report. I'm more than happy to host them here on my channel. So if you guys are new to the channel, feel free to subscribe, drop a thumbs up, and I'll keep you up to date with the series CPI data reports, PPI data reports, unemployment reports, and of course these Fomc meetings. So, alrighty, I want to see a show of hands. How do you guys think the Federal Reserve will be reporting today? Do you think it's going to be 0.75% or 0.5%? I do have a position. I just announced it to our Learn Plan Profit group under our trade ideas section. So I appreciate you asking. 0.5, 0.5, 0.5. There's a couple 0.75s in there. I respect that, right? Obviously, just like some people want the market to go up, others want it to go down. They're shorting the market. At the end of the day, again, I'm not here to convince you to be on my same side of things. If anything, I want you to be your own person. So I hope that regardless if the market's bullish or bearish, right? We're all adults. We all take advantage of what we see fit. Hold yourself accountable, manage your risk, manage your position size. Don't put yourself in a position that you can't tolerate, and congratulate the other side if they end up winning. Who cares? Their win doesn't take away from, I guess it does in this sense, like they win, you lose if you're bullish and they're bearish, but who cares, right? It's not like they directly took your money, right? It's part of this system. We choose to take advantage of opportunities we see fit. So just want to make sure that you guys are aware of that. Let's see. All right. So in the next 2 minutes, we shall be seeing the market react to this. All right, I'm just posting this one on Instagram. All righty. Should be fun. So wish you guys nothing but the best. Again, if you're an absolute beginner, market's going to be very volatile shortly after this report. And then 30 minutes after, Jerome Powell is going to be speaking. If there's enough people that drop a thumbs up on this video, I'd be more than happy to host the live stream for you. If not, I can close it out right after. I'll leave it up to you guys. So just depending on how this live stream does. But I wish you guys nothing but the best. If you do not want to partake in this, close your position or reduce your position size so you don't put yourself in a position that you can't tolerate. If you're okay with taking on this risk, then great. Wish you nothing but the best. Hope that earned your thumbs up and hope that you can consider subscribing. All right, so in the next couple of seconds, it should be released. And again, I have mine here on the FOMC rate decision, and then I have the live stream pulled up for the Federal Reserve. So I'm pumped. I'm ready to go. All right, you guys ready? You guys ready? Let's see it. All right, any second now, market should be reacting. And it looks like it's pulling back. There it goes. It's dropping. Oh, that's not good. Is that a 0.75%? There it goes. Dropping hard from up 2%. Wait. Shifting directions now. And I hate when it does this because a lot of people got stopped out there. Be careful here with your position though. Again, there's nothing wrong with reducing your position size if you can't tolerate it. Congratulations to all the bears right now. There it goes. All right, it's selling off. All right. No, it is a 0.5 and market is selling off. Let's give it some time. Locked in 2%, yeah. For some of our short sellers, you might want to be careful with your position. You might want to lock in profits while you're ahead. Just my 2 cents. If it is 0.5%, it just might take some time, but market should be going up. At least that's what the market expectation was. All right. There it goes. Yep. Expectation 4.25 to 4.5. Yep. Interest rate hike is 0.5%. So, and yep, that's exactly what we wanted to happen. But market is pulling on back. It's not anything too dramatic. I mean, we're definitely in the red. That was a 1% drop. This isn't as dramatic as I thought it would have been. Fed fund rate is higher. Okay. All right, let me double check. Nope, we're selling off. We're selling off. Look at that. Selling pressure is high, and now we're at a 1.7% loss for TQQQ. And again, you can't want all of the good and accept none of that bad. And there it goes. It's selling off. A 4% sell-off. 4.3% so far on TQs. All right. Here it goes. Yeah, he does speak. He's going to be speaking in the next 28 minutes. So I'll leave it up to you guys. If you guys want me to continue to host the live stream while he speaks. Here we go. All right. Yep. See if we're actually finding signs or showing signs of a support. No. Well, let's look a little bit more into it. I'm going to post this so you guys all have access to it in the live chat. I just want to make sure that you guys all have access to it as well. And I'm going to pin it just in case you guys do. So the same statement from the Federal Reserve that I'm reading. Again, our goal is always to make you guys self-sufficient. So not just something that I'm reading and how I interpret it, but, you know, however it is that it makes sense to you. So recent indicators point that the modest growth in spending and production job gains have been robust in the recent months, and unemployment rate has remained low. Again, we don't like that. And by we, I mean the Federal Reserve does not like that. Okay, it is beginning to show signs of a support. Just be careful. I'm looking out for all of the bears right now. Selling pressure is, you know, there's no break of pattern. It's still bearish, right? But if we begin to make higher highs for all the people that are short selling, again, I don't care if you're bullish. I don't care if you're bearish. I just want you to keep some of your profits, right? I don't want you to give it all back. So if you do begin to see some higher highs and higher lows, just understand that, again, volatility is going to be very, very high for the next 30 to 45 minutes as we wait for Jerome Powell to speak. Reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Russia's war against Ukraine is causing tremendous human and economic hardship. The war related to the events. Silent inflation risk. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the next long run. In support of the goals, the committee decided to raise the target range of the federal fund rate. Okay, so yeah, the committee's anticipation on the ongoing target to return inflation 2% over time. We'll continue to hold interest rates. Brokerages. Yep. All right. Yep, nope. Selling pressure is still there. Selling pressure is still there. Okay. I did share it, right? Okay, you guys have it. It's on the top pin post. All right, I shared the link with all of you guys, so you guys all have access to it as well. So if you guys wanted to review it or just have access to it for your records, all power to you. Remember, I want you to know where these things get released, and it's on the federalreserve.gov website. So, let's see. All right, still bearish, right? And I'm telling you that I was bullish, and I'm okay with admitting that, yeah, it is bearish, even if it is showing signs of a support. The time where I would be like, all right, bears, maybe it's time to lock in profits, is if it begins to indicate actual signs of a reversal. Right now, it's showing signs of a potential support, but it's not indicating signs of higher highs or higher lows. So if I was shorting the market, again, I'm trying to put myself in your position, I would be cautious right now, but we're not making higher highs or higher lows. So at this point, I still see there to be more selling pressure than buying pressure. So I'm, again, right now looking out for all of the bears in the sense that just have that stop loss or have that exit plan just in case we do begin to see that reversal. But as of right now, I would, I'm not going to be like other people and be like, yo, bears, you better get out, right? It's about to take off, just because it would be in my benefit in that case. But no, I want you guys to make as much money as possible. If you're shorting the market, all power to you. I would wait for a break of support, but I would be very, very careful if we begin to make some higher highs here. So this is a bear trap. Again, I'm not here to be a conspiracy theorist. It is what it is, right? Market reacted the way that it reacted, and it doesn't matter if it's a bear trap. If market does begin to recover, people that are shorting the market should be aware enough. You should not be shorting if you're a complete beginner. And if the market does begin to recover, that should be a huge red flag for you of, hey, I need to get out. I need to lock in my profits. I need to keep some of those profits in my pocket. But as of right now, no, it does not look bullish, right? We are showing signs of a support, but it's still selling off. Look at that huge red candle, right? As of right now, if I was a bear, I would be holding my position. There's no break of pattern here. So I will set an alert here. If we break above this, that would make a little bit more sense. So again, I am all for you holding your ground if direction is in your favor. And trust me, right now, bears, direction is in your favor. So congratulations to all of you guys. Thank you for showing this. Of course, Donna, appreciate you tuning on in, and hopefully I earn your thumbs up in this video. So we have about 3,000 of you guys here. Again, Jerome Powell is going to be speaking in the next 22 minutes. So if you would like me to host that live stream, again, all I literally ask you to do is to drop a thumbs up on this video. And if this video gets over 1,500 likes, we'll stay live. If not, respectfully, I'll close it out, and we can all react to it individually. Here it goes. Yep, market's dropping. All right. When will Jerome Powell speak? He speaks in 20 minutes from now. So he speaks at 2:30 p.m. Eastern time. Why the sell-off? So again, we just shared the link. Oh no, well, not just, but we shared the link. I don't know if you see the link on the top pin post to the Federal Reserve from the Federal Reserve website. So it's the actual report itself. So they just they raised their target for their federal funds rate. So and one thing that I started thinking a little bit more about, a big focus that they continue to always talk about is their soft landing at 2%, but also their overall idea of reducing their balance sheet. And to my understanding, that reduction of balance sheet hasn't even fully taken place yet. So I'm live right now. What's up? milk and chips and just fruits. Okay, thank you. Oh, and tea. Thanks. The volatility is cray-cray. Thank you for your help as always. I appreciate that. Thank you. Yeah, you guys. Milk and chips. Yeah, I have an appetite of a 6-year-old, so yeah. Now I'm gonna get roasted because of my diet. Uncrustables. Oh, she knows. Ricky, milk ain't good for you if you're sick. I know. I have heard that, but I love chocolate milk. Market is goofy. It is what it is, right? I'm never here to blame or use anyone else as a scapegoat for if I choose to take advantage of an opportunity. And again, this is 100% my opinion. I think that when he begins to speak, market will begin to recover, but I'm not going to go in blindly and begin to step on the gas if direction's not in my favor. I just think that, that people want a little bit more of an explanation. So I'm excited to see what happens. If you're too scared, and rightfully so, if you're a beginner, if you're inexperienced, if you just don't see it because you see it to be too risky, I respect that. Like, don't go into anything that you don't feel comfortable. Let the market sell off. If you think that it's going to sell off more, but you don't feel comfortable shorting, then don't short, right? You don't always have to have an open position. We talk about this all the time with our LPP team. Any open position is a position that's open to risk. So again, I'm here to encourage you to look out for yourself. That's all we ever want you to do. Don't focus on or don't care about what I'm doing. Don't care about what other people are doing. Care about what makes the most sense to you based off of current conditions. And right now, we're not seeing any progression on actually recovering. We're holding our ground, right? That's great. This isn't even that, in my opinion, it's just my opinion. NASDAQ is down 0.55% on the day. I don't think it's anything too significant. I'm excited to hear what he has to say. And if things do get worse, then again, let's accept the loss. There's nothing else to it. Why make it more than what it is? It's just one day. One day out of 218 trading days in the year, right? Something like that. 218, 222, something like that. Don't overcomplicate it. Don't make it more than it has to be. And for those that have a green day, celebrate, right? I would be more than happy to congratulate all of you guys. If you guys shorted the market, you guys killed it. I'd love to post to you guys. I don't ever have to, let's try to not get so offended, right? If one side wins and the other side doesn't. It is what it is, right? We're all here for this, the same exact reason. That's to make money. Let's congratulate one another. Now, I don't need you guys gloating, right? And be like, Ricky, look how much I took away from you. No, I like hyping our people up, right? I love to post you, and that is what it is. So I'd rather have that type of approach or mindset rather than if you make money and I don't, you're my enemy. Yeah, I don't like that one. Umar, you crack me up. Learn to play both sides, definitely, but again, that comes with time. It's not something that we'd ever want to recommend for beginners, because if you trade both sides and then market begins to recover, then now you just took 2 losses, right? So that's not always the case either. And that happens a lot with either shorting the market or trading inverse ETFs, and something to be aware of, something to be cautious of. It's something that we talk about in LPP. Congrats to the person that got my 1K. I love that. Any update on the hypercar? I don't have a hypercar. No, I need to sell a couple of my cars first before I have way too many cars right now, and car market isn't looking the best. So maybe it's time to exit that on some of them. Some of my other ones I'm doing pretty good. I do not trade options. I appreciate you asking, but I do not. We have 15 minutes left until that Federal Reserve FOMC minutes speech. So we have 1,200 likes. We're looking for 1,500 likes. So again, if you guys want me to stay live, I'm going to give it 5 more minutes. Just make sure you drop a thumbs up. Make sure that you stay subscribed to the channel, especially if you want to participate in that live chat. Powell should be positive. SF90 is gorgeous. I agree. It's a beautiful car. I have a couple of buddies or people I follow on Instagram that have that car, and I think it's amazing to see what they have. Definitely. You guys know what I do. I focus on buying something for a good deal. And if it's not a good deal, then I won't put myself in that position. So I appreciate you suggesting it, though. It is a beautiful car. Do you trade Forex? I do not. I've never traded Forex. I don't trade options. I don't trade for other people. I offer one thing, and that's my LPP team. And I work with them every day. That's all. I offer literally nothing else. So if you want to learn more about that, it's the second link in the description. If you don't, I'm not going to force you to. I just want you to know what I do offer. So, all right, 1.6K. Wow. That's all I had to do. I just had to ask. All right, now 2K. Not going to ask for that one. Just kidding. LPP, baby. You know what it is. All right, we're still getting rejected. Remember, we're looking for progression, and this is not progression. Same resistance. It is testing for support, but that doesn't mean anything, right? We're looking for the break above the EMA. We're looking for higher highs. We're not getting any of that as of right now. Oh yeah, I forgot to tell you guys. Just for you guys tuning on in, it's going to be active for the next hour to 2 hours. And you guys do not have to. You guys know that we just offer things. We have our shop TechBud site. It's the fourth link in the description. And we're giving away a free trading journal, right? So if you're someone that wants to be able to track your trades a little bit more, you get it for free with every order over $25. So let's say that you pick up, you really want just a Wall Street shirt or whatever it is that you want. Let's say that you want like a trading mouse pad. You pick up a mouse pad, you need to add this to your cart. So let me go ahead and show you very quickly. You add it to your cart, you add your favorite item. You can pick one item, you can pick two. And by adding it, it gets automatically discounted at checkout. So you can see here, you get it for free. Okay. So just want you guys to be aware of it. I do appreciate you guys tuning on in. If you want it, great. If not, again, it also enters you automatically for our giveaway. So we're giving away a new item every single week. We're giving away a PS5, a DJI, and then an iPad as of right now. So yeah, just want to make sure you're aware of it. All right. And again, that's the fourth link in the description. It's shoptechbuds.com. I do not have a PS5. I actually bought two of them, one for the giveaway and one for what I was supposed to keep. And I ended up selling it to my cousin because he wanted a PS5. And I was like, you're right, I probably shouldn't play. But no, I don't have a PS5. I just know that they're really popular and that they're really hard to get. So I thought it would be a good item. You guys know that I like to just spark things up. Some people like it, some people don't. But iPad, a drone, and a PS5 and some Beats headphones. So we are going live for the Jerome Powell speech. So, all right. All right. Yeah, I sold the PS5 to my cousin for $50 more than I bought it for. I had to, right? I didn't know how much money people could make off of these dang little things. I mean, I used to sell, not PS5s, but I used to sell iPhones, remember? When I was like 13, 14, 15, so yeah. Not this one. I had two of them. This one's for our giveaway. Don't worry. Yeah. It was still one of the cheaper ones that was posted, so yeah. Ricky, would you ship to the UK? Yeah, if you win, definitely. Drove an hour plus for a PS5 yesterday. I know. I mean, especially during the holiday, right? Alrighty. Still that same resistance, right? Descending resistance. Watch for the break of support. And if we break below the support, we're selling right back off. Yeah. So for those that are tuning in a little bit late, I already have something that's pinned right now, but I'm gonna have to pin this because so many people are asking. Here we go. So the FOMC did raise rates by 0.5 for 50 basis points, right? And that's what we wanted. But what's it called? Give me 1 sec. Let me pin this. Replace pin message. Can you guys see it up there now? Does it show on your guys' side of things? Here it goes. Watch for the break, lower lows and lower highs. So why is it not 0.25% basis points? That's too low. And again, 0.5% is still progression, or it's still progress, sorry. We were previously raising interest rates, and by we, I mean the Federal Reserve. They're raising interest rates 0.75%. So this is progress. It's a less aggressive interest rate hike. So we were correct in the sense that we did believe it was 0.5. But as of right now, market is downshifting. Yep. All right. Here it goes. Selling off, not surprised. Isn't raising rates bad? Yeah, but we knew that they were going to continue to raise rates. So they've been raising rates for the better half of this year, and they've been more aggressive for the past, 4 interest rate hikes at 0.75%. So yeah, it is still bad that they're raising rates, but we're nowhere close to where we want to be, right? We're at 7.1%, and their goal is 2% for core. And right now, I think core inflation is at 6%. So it's coming down, and it's coming down quicker than expected. But remember, their job is still to moderate inflation, right? And I do apologize for sounding like this. Again, I am just a little under the weather. I don't feel that bad. I'm like losing my voice, and I have like this like cough. We all do. Myself, my daughter, my girl, all of us. So happy that I can go live from being at home. Why are you tracking QQQ and not any other stock? I like to focus on NASDAQ, and this is a NASDAQ ETF, so it's a 1-for-1, right? So NASDAQ should be moving the same way, right? Because if this thing moves up or down, an individual stock can be doing its own thing, but NASDAQ is a fund of, a much larger pool of stocks with a big focus on tech, and that's what I have a big focus on. So stop drinking milk. Okay. Yeah, so I'm looking a little bit more into it on the what's it called? On why exactly the market is dropping. And we are raising interest rates at the rate that we wanted, right? Which is 0.5%. But it looks like the peak rate, right, of all these interest rate hikes is now expected to be at 5.1% instead of the previous of 4.9%. So after yesterday's CPI, it's just a little bit more than we expected. And that's why we're seeing this downturn, because it's kind of like the longevity of how many more interest rate hikes are we going to have. And at this point, it looks like we're going to have about 3 more interest rate hikes, maybe at 0.25% instead of the expectation of 2, which was before today, right? And I think it's just yesterday's CPI data report kind of got us maybe a little bit too excited or too confident that they could slow down much quicker than expected or completely stop raising interest rates, right? Like one of you guys asked me of like, hey, like, shouldn't we just stop raising interest rates altogether? Well, there's at one point, yeah, eventually, once it gets a little bit more controlled. But as of right now, it looks like they're still going to want to do about 3 more instead of 2 versus what was previously expected. So, and again, a lot of people get very upset with the Federal Reserve. You just have to understand that's their job. And their job is to moderate inflation. And yes, it does hurt us, right? There's a great quote of, it's short-term pain for long-term gain. A lot of people are complaining because markets are down. And yes, trust me, it is frustrating to like see the markets down this much for this long. It's been all of 2022, but you have to understand, like, they have pulled back so much that if markets do begin to recover, there's huge opportunity right now. And that's what I want to continue to remind you guys, not to get overly confident, not to get too excited, but just to remember, right? Short-term pain for long-term gain, for all of our investors, for all of our swing traders, for those that are trying to, invest maybe a little bit more heavier into your 401ks, whatever the case might be. I just want to make sure that you guys are aware of that. So yeah. So 1.7K likes. If we hit 2K, you got to do the live stream shirtless for the boys. No, I'm not doing that. No one wants to see that. So, Ricky's speech is making the market reverse right now, dude. I cannot move a market. I have 2,000 or 3,000 people watching. That's nothing in comparison to. I would need 1 million people with a decent account size. So how do we join the giveaway? If you want to learn more about the giveaway, click the 4th link in the description down below. And you could also enter or get a free journal today with every order. Just add it to your cart. So we'll talk about that in just a little bit. I am sick. So, all right, 1 minute until JP. So I'm going to start the speech. Again, I just want to say thank you guys again for giving me your time of day. I really do appreciate it. I hope that I do earn your thumbs up. I hope that you can consider subscribing. And if you ever have any questions, literally just send me a direct message via Discord. And that's that first link in the description. Don't look at how many followers I have. People get discouraged because they don't think I'm going to respond. Sometimes I do take a lot longer to respond. You can message me in 2 places, via Discord, which is the first link in the description, or via Instagram, and that's that 3rd link down below. I will never message you first. Those are all fake accounts, and I'm verified on Instagram. That is my only account. I do not trade for you. I only offer one thing, and that's LPP, and that's that 2nd link down below. Please make sure that you are aware of all the fake accounts that try to message you through WhatsApp or Telegram. I have none of that, so please be aware of that. Anytime that you see anything like that, just send me a message, and I'll do everything in my power to try to take them down. So appreciate your time, and I hope you enjoy. JP is late. There we go. I wonder if JP is still rocking that same rollie from last week or last speech. Remember that one?
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month.
Market selling off.
Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices.
1.5%.
The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a 0.5 percentage point higher than projected in September. The median projection
That's why the
is
market's
4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year. But our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves. And many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that were published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today
That is not good.
is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward.
That's a good
and
question.
And then I wonder what you're looking at as you determine when to stop.
Yeah. So as I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed and pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we
Be careful, bears. Be careful. We're above EMA now.
The question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at the...
He's not answering the question, so pretty much what she asked is, you guys in 2023 intend to raise interest rates 0.75% total, right? Is this going to be done all at once or in 0.25% interest rate hikes? And he's like, well, we don't know the pace.
Things get fixed and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market. One where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated.
Yeah, I mean, 100%. So I think never say goodbye. You probably can't answer that question now. I completely agree. And some people get really offended by it because they're asking very specific questions, and in his position, he's not allowed to answer those, like, that exact question right away because he might not even know the answer, right? If economic data does come in actually softer than expected, then yeah, it could probably be sprinkled throughout the year. But if it comes in harder than expected, right, then they're going to have to be more front loading those interest rate hikes. So it comes with the territory.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. 0.5 percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about 0.5 percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report that had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting. and participants know that they know this, that they can make changes to their SEP during the meeting, well in advance of the press conference so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now?
That's a good one.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the media, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see though.
Colby?
Thank you, Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria?
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation's running now, well more than
You guys are ridiculous in the live chat.
Remember that the jump off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down, I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases, we just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally and improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral?
That's a good one.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the...
All right, guys, I'm going to leave it here. Again, if you guys want to, he's probably going to be speaking for another 5 minutes. I'm just going to go get some water and freshen up. So you guys were too much fun in this live chat. I was seeing some of your guys' comments. You guys cracked me up. But again, the way that I view it is some of you guys were getting bothered by Jerome Powell not answering the questions directly or not trying to give proper expectations for up and coming interest rate hikes. You just have to understand that's his job. First off, he might not even fully know. Second, he can't be disclosing everything. When it comes down to overall market and market progression as of right now, I'm actually quite surprised that the market didn't sell off. I mean, based off of the report of, the interest rate was where we wanted it, which was 0.5%. It just came in with a higher expectation of future interest rate hikes for 2023. So that's why we began to pull on back. So as of right now, I don't know where the market is going to be going. It looks like it's trying to show signs of a support. I would just be very careful. Even if the market does recover, it literally is 1% that it has to recover. And I think at its peak, it was up about 1%, so 2% total. So today was not as crazy as I thought it would be. And one of the things I was looking at is on this 1 hour time frame, we're literally still trading within this little range of right around like 280 of a support and then right around 295 of a resistance for the NASDAQ ETF QQQ. So everything was not as expected. So I see someone saying everything was as expected. No, the up and coming interest rate hikes were not as expected. It actually came in a little bit worse than expected, a little bit higher than expected. And I think that's why we're seeing the market react the way that it is because there's more interest rate hikes to come in the up and coming future. But as you can see, the bulls want the market to go up. As of right now, I'm taking it day by day. I still think that now is a great time to begin to prepare to invest. And preparing doesn't mean that you have to go all in. But to begin to formulate that trade plan. So if markets do begin to recover, that you can properly take action. So I'm going to get some rest. I'm just going to chill today. I'm going to start catching up on my messages. I already see that I'm getting a bunch of messages on Instagram and on Discord. So again, if you want to reach out to me, I respond to all of my direct messages. First link is if you have trading related questions, send me a direct message via Discord. But if you have any other random questions or you just want to follow me on Instagram, that's that third link down below. I am verified on Instagram and that is my only account. All the other ones are fake. So I wish you guys nothing but the best. Friendly reminder again, we are doing our little giveaway. If you guys didn't check this out, we're giving away a PS5, we're giving away an iPad and a DJI drone, and $2,000. So we're doing weekly micro giveaways, which are one of these smaller prizes. And if you want to enter and learn more about that giveaway, that's that fourth link in the description down below. And we are giving away a free journal with every order today. Just add that trading journal to your order and you get it automatically for free at checkout. So I appreciate your time. Hope and wish you guys nothing but the best. Thank you guys for all the positive comments. And again, hopefully some of you guys can consider subscribing, turn on your post notifications, and I'll do my job in keeping you guys up to date with all these different live streams on economic reports and interest rate hikes. Like always, let's make sure that we end the year on a green note. Take it easy, team.